I want to welcome everyone to a trading metals seminar today. Just a couple of quick announcements. We're also hosting with the CME Group in Fundamental Analytics next Tuesday a fall energy seminar with a very distinguished panel. So hopefully you've all received the invite for that in your email boxes. If not, let me know afterwards and we'll make sure you get an invite to that. That's next Tuesday. Also, FIA is October 20th to the 22nd, and we've got complimentary exhibit and trade show passes. You should have received an email on that. If you haven't and you want to register for FIA through Advantage, definitely just grab me afterwards and we can send you the email link to register. Then I want to quickly introduce our speakers today. First, we've got Bruce Gilbert from the CME. Bruce is the director of metals products. He joined CME about 4 months ago. He's responsible for new metal development in the over-the-counter space. He's also responsible for the overall growth of the existing metals complex, including precious and base metals. In addition, we've got David Hightower, who's the principal of Hartfield Management, a registered commodity trading advisor and editor of the Hightower Report newsletter. I don't know if everyone received the commodity trading guide up front, but this is a great annual publication. The 2010 one will be coming out shortly. Hightower Report produces research reports daily via proprietary quote systems, fax, email, and in 2004 launched its comprehensive Research Center website. The Research Center provides insights daily for market forecasts, including pre-opening, verbal, midday, and aftermarket reports, along with trading ideas utilizing both futures and options. With that, I'm going to turn it over to Bruce, and thank you again for attending today.
Thanks. All right, thank you, Iqbal. As Iqbal said, my name is Bruce Gilbert, Director of Metal Products, and I'm based in New York. At the CME Group, we recognize the importance that our member firms play in both driving industry growth as well as providing a window into the needs of customers. And as such, I'd like to thank Advantage Futures, who has been a leader in providing technology, infrastructure, and support for high-frequency traders, as most of you know. And it really gives me great pleasure in saying that since 2003, as a clearing member of both the CME and CBOT, Advantage has cleared over 1.5 billion contracts. That's quite an accomplishment. So thank you for that. And congratulations also for gaining member status at NYMEX and COMEX this past spring. And we wish Advantage continued success, and thank you for supporting events like today. And last but not least, before I start, I'd like to also thank those of you here who clear your business through Advantage, for it's the participation of professionals like yourselves that help make our markets transparent and liquid. In my role at CME Group, I look to sponsor research and provide education on key issues that benefit the business of our customers. And to that end, we should all be looking forward to hearing from David Hightower a little later on. So let's get started. Let me ask a question. This is the interactive portion of the presentation. How many here currently trade metals? Can I see a show of hands? Okay, that's a good percentage. And you're trading CME metals, I assume? Okay, some good nods, okay. My background is in metals for about this many years. 12 years at Lehman Brothers, when there was a Lehman Brothers. I created and managed the physical precious metals group, where we dealt with central banks, mining companies. We got involved in project financing loans, and hedge funds. I worked for Mitsui, the big Japanese trading company, in the base metals group, where I was charged with developing business with corporate clients in the US and as well as hedge funds. And then some of you may know that I worked at Cargill Investor Services, where my last position there, I was head of global sales for our futures clearing and execution business. And then, as you know, Refco purchased us, and what seemed like about an hour and a half later, Refco blew up. So anyway, so here we are today, where I'm going to spend the next 15 minutes or so, reviewing our suite of metals products. I'm going to compare our gold contract to that of other gold exchanges. I'm going to introduce a trading idea. I'm also going to discuss some new initiatives for metals products at the CME. And then I'll finish the formal part of the presentation by asking for your suggestions for improving existing products or suggestions for new ones. And then if we have some time, we'll do some Q&A. So let's look at what we have in terms of metals. Precious metals, we mean gold and silver, PGMs, platinum group metals. That would be the platinum and palladium complex. Base metals, only copper at this point. Ferrous, we have a new steel contract, hot rolled coiled. And we have a very new product, which we'll talk about a little later on, for clearing over-the-counter transactions. And it's a very new product. It was launched about 2 weeks ago. Take a look at this. It may take a few seconds to get your eyes adjusted to it. This lists all the metals contracts that we do have and some of the key components of them. I'd like to point out a few while you're looking at it. You can see there's a wide selection of products that we do have covering precious and base metals. The contracts vary in size. The position limits, which is something that the world is talking about now, I think these position limits are probably the proper balance in terms of delivery limits and total number of contracts you can have in any 1 month or in total. Though it's not stated on here, but it's implied, obviously you have the strength of the clearinghouse behind each and every one of these contracts with an $8 billion guarantee fund, which I don't think any other exchange can claim to have anything close to that. And I know to this group, the open interest numbers and the volume numbers are of interest. If you take a look at that, you can see the numbers are fairly significant. Yeah, obviously, the last few days have been pretty spectacular in the gold market, so congratulations to those who got ahead of all that. You could also see the multiple venues that we trade on. There are options on most of these contracts except for the steel contract. That may be coming at some later date, but the contract is relatively new, so there is no history of volatility. So let's quickly look at some volume comparison numbers, which I know is of interest to a lot of people here in the room. A number of people often ask me, how has volume been? And you can see on the top line, I wish I had a pointer, but the top row going across, you will see that our volume has been on an upward trajectory, and it seems to be enjoying a larger and larger share of exchange-traded global volumes. September, metals were up about, in terms of volume, up about 23% from August. So it gives you an idea of how our business is growing. I'm going to show you the same numbers, but I think this depicts it a little clearer. The bright orange, which is our volume, you can see historically we go back to 2005 because that's when the ETF was launched. We wanted to make a comparison with that. You can say typically our volume seems to hover anywhere between 60% of the global volume. Now, volatility is very important. Let's talk about that for a second, particularly to people in this room. Some like it, some don't. And you can see here at the end of the scale, the dollar index is at the low end, and at the high end would be the WTI contract. The first half of this year, the dollar index has averaged around 12% volatility, and the WTI somewhere in the neighborhood of 60%. But why did I want to show you this slide? I wanted to show you the slide because I wanted to compare gold's volatility to that of the other commodities. It's tame relative to WTI. It's even less than the S&P. It's tame compared to some of our other metals. Copper, platinum, and silver are on there. So if you're trading metals and you want something that has a lot of volatility or a good amount of volatility, you would look at platinum, copper, and silver. If you want something that is kind of in the middle, that would be the gold. And depending on your appetite for volatility and risk, gold may be the kind of contract you'd be looking to trade. So whatever your sweet spot is, you may find it in our metals complex there. want to talk about a possible trade idea. Is anyone here trading the gold-silver ratio? Does anyone trade that from time to time? Okay, good. A couple of people here. David? Okay, good. Now, this is the trading idea I alluded to earlier, but I need to begin this with a disclaimer. I'm not endorsing it, and neither is the CME. But it is something that many people in the business have traded for many, many years. So if you're looking at another way of trading metals, gold, silver, for example, consider this, the gold-silver ratio. But here's my main caveat when trading this or thinking about trading it. There is no economic reason for the relationship. There's no natural arbitrage between the two metals. There's nothing fungible between them, unlike other products. And let me give you some interesting factoids. Kind of like to sound like a little cap inside the Snapple bottle. The last 450 years or so, world production, that ratio of gold silver has been 13 to 1. In 2006, it was 8 to 1. At the time the U.S. Constitution was being considered, the founding fathers were looking at a ratio of 15 to 1. They wanted the U.S. to go actually on a silver system. Why, you asked? I heard someone ask that. Why? It's because a lot of the founding fathers had ownership in silver mines. So they were looking to protect their own interest, 15 to 1. When I got into the business, it was 32 to 1. That was the conventional wisdom at the time. In the 90s, as you can see on the chart, the ratio was in the 90s. And today, it's about 60 to 1. So again, many traders do play this ratio. And if you are trading it, just recognize the fact that there isn't an economic reason for the relationship. But if you feel you have the feel for the relationship between the two metals and how they're going to behave at some point in the future, it is something for you to consider. And let's talk about some of the new initiatives at this CME. We recently launched, 2 weeks ago actually, this new product called Cleared Over-the-Counter London Gold Forwards. It's a mouthful. It was created in conjunction with the London bullion community, who over a year ago came to us and others and said, we have a problem. We have a problem with counterparty credit risk, as you can all imagine what we all went through in the financial markets. And so we listened to them, we had some meetings, we created a solution, we launched it 2 weeks ago. Essentially, is anybody here trading gold over the counter? Anyone contemplating it? A few people. Okay, so I'll run through it pretty quickly what it is. If you do an over-the-counter trade with another counterparty, a bank or whomever, and neither of you want each other's credit risk, you can take that trade, put it on Clearport, and it clears through us. The price doesn't change. Any of the specifics about the trade do not change. It stays as an over-the-counter trade. So what does that mean? It means that you no longer have risk with one another. You don't have settlement risk. You don't have operational risk. We take care of that. We are the buyer to every seller, the seller to every buyer. And if you are a bank, which I know you're not, but why the banks like this is because it gives them more capital efficiency. They no longer have to put up a lot of capital to protect the over-the-counter positions, which they are required to do under Basel II. The trades do not become futures. They stay as forwards. They get margined. Collateral is posted and collected. And at settlement, we deliver the gold, take delivery of dollars, and vice versa. So we stand in the middle between the buyer and seller. Our intention is to roll this out into silver, platinum, and palladium in 2010, and also to have options on those metals. Some of the other products, iron ore, scrap steel, and flex options are being contemplated amongst others, but I thought I would show you these. And so let me just ask you here, let me just close that part of my presentation by, if I could, just turn the attention to the audience. And is there anybody here that has any suggestions for how we can tweak, change some existing products? I'm open to hearing anything. Any ideas for new products? And if you're too shy to talk about it now, I mean, please, meet me after the meeting. I would love to hear that. That's how we create new things. Just so you know, so far this year, we've created 303 new products based on customer demand. So we do listen.
About developing any interest in aluminum futures?
We just went through that. No, we just went through that. We just delisted that. Yeah, great question. Great question. We just delisted it. It just didn't fly here, and there's a lot of reasons. We can talk about that later. Yes, sir.
What about a gold-silver contract?
The ratio contract. Okay. Is that something you'd be interested in?
No, I work for the
Yeah, I know. Yeah, okay. I mean, people have suggested that, yes. John?
Yeah, we had talked a little bit earlier. I think you should really look at a physical delivery kilo contract to mirror the NYSE life contract, where you have physical delivery. And I think that'll be big if the price of gold continues to go up.
Right. And we are looking at that.
Great.
Good. Thank you. Thank you for those comments. And please find me after, and we can talk in more detail. So that takes me to the end. We've covered a lot of ground here. We've talked about volume. We've talked about volatility. We've talked about some of our new initiatives. We talked about a whole host of our products in our product suite. So I want to thank you, and it's been fun being with you this afternoon. And I'd be happy to take some questions now, other than what we just talked about. Anyone has any questions about what I spoke about? Okay, thank you very much.
Thanks, Bruce. Got to get going here. I typically have several hours worth of material planned regardless of how long I'm supposed to speak, but it's kind of hard where I come from. 25 years in the business, day after day getting down in the trenches and watching the little EKGs of all the commodity markets, because I've went through the very dead times, the stagnant times. I've went through the initial globalization period in which commodities really came alive, and it's my opinion that the subprime crisis just kind of it was halftime. It called the game for a while, but it didn't change the score, and it didn't change the trend of the outcome. I told someone earlier today that 5 to 10 years ago, I probably would have said, someone that was talking about entertaining a career in the futures business, well, maybe you should get away from it. But the advent of China and the globalization and all the other developments that have taken place kind of have totally changed my mind. This could quite literally become the center of the economic universe. The fact that we've went through this big paper to hard asset cycle, and back 10, 11 years ago, we thought that the metals markets, the central bankers in all their infinite wisdom said gold is no longer a viable investment interest, and we need to begin to divest ourselves of the gold market. And to me, that was the trough of the commodity deflation cycle. And we see that the central banks are still in a selling posture to this day, and in fact, they should be on the other side of the coin. Needless to say, this is a bad week for me to give this type of presentation, because it's hard to restrain myself from seeing some of the developments that I saw earlier this week. But I take a top-down approach. I look at the big picture view, and I try and bring it down. It used to be that commodities would focus entirely internally, and they would look at their fundamentals, and they would come out of the pit with their information, and a lot of that information was in the pit, and a lot of knowledge was in the pit. And 5, 10 years ago, that knowledge started to dissipate and to spread around the globe. And the participants started to spread around the world. And the production of commodities began to spread around the world. And the consumption of those commodities spread around the world. So that now we have this information, this demand and this supply coming from everywhere. And so that can't help but breed volatility. And what I've always thought, and I was asked if I would testify in the energy manipulation or anti-speculation campaign, and I refused because I thought that there was a bias already, and they wouldn't be listening to what I was saying anyway. But it's my mind that $140 oil was a necessary early warning shot, and that's what these markets provide. That is the ability to realize a problem, to figure out a way to substitute, to expand production, to reduce consumption, to do something about that. And so without this early warning signal of extreme pricing, society would be in a lot bigger trouble than it is today. And so saying that, what do I bring to you? If you guys are shorter term algorithms, systems traders, spread traders, there's a guy in this building, Peter Stottlemyre, that developed the liquidity data bank and some of the very first systems trading in the intraday type of analysis. And he always told me, he said that even though you have these systems, you still have to be aware of which way the big trend might be moving. And I think that's very important, especially in an environment in which we're going to see greatly expanded volatility. In my mind, we've not seen anything yet. We're going to find out that allocating these resources globally is going to be a really important and difficult process at times. And so with that, I'll start big and I'll come down, and I'm going to have some opinions. And interestingly enough, I kind of agree with Bruce on the gold-silver ratio, and for a lot different reasons and strategies. But nonetheless, in a big picture view, we have a big world and we have small commodity markets. We have times in which we can implement some kind of new commodity instrument, and we'll see more demand that we can actually produce for that particular commodity. We find out that as opposed to 10 or 15 years ago, we would have a surplus in the crop area, and it would take us 2, 3, 4 years to work that surplus off. Starting about 5, 6 years ago, I remember one year in particular in which we started out at the beginning of the year, and the talk was we would have record soybean oil supplies. Then 3 months later, there was talk that we would have a record shortage of soybean oil supplies. And then by the end of the year, it was back totally in the opposite direction. Now, you might attribute that to bad analysis or bad speculation by the marketplace, but it truly was happening that the stocks to use ratio in a number of commodity markets has become so narrow that we can run through our supply. And another factor, it's just a law of numbers. If you have a 12, 13 billion bushel corn crop versus a 5 billion corn crop, say 10 years ago, the 10% setback off the weather is going to be a lot larger number when you have that larger crop size. The other side of the coin is when you have demand from China and India and these other countries that amount to such a significant portion of the total production, then you're going to have demand influences that shock the market that will run us out of supply. Just as in the wake of subprime, we had some negative demand shocks. And from very quickly within that crisis was our view that many commodity markets have been here before. They know how to react to this. This is not the first time around the block for us in terms of crises. We had Chernobyl. We had all kinds of problems in the past with droughts and so forth, and the copper market's a prime example. What happened in the copper market? Biggest collapse in financial structures in 50 to 100 years. And what happened in the copper market? We saw a tremendous slide in prices, absolutely. But we immediately saw 5 producers who represented a significant portion of the world productive capacity idled their production. Tomorrow, shut it down. So they immediately took control. Instead of building up this vast oversupply of copper, they immediately took control, and copper actually started to tighten and was tightening up until about June 1st of this year. We are seeing a tightening of copper supplies, and that's why copper's been so reactionary. So we now have big world and small commodity markets, and guess what? it's not going to get any easier because the world expects to be able to consume as much as they want. The standard of living, people are rising around the globe. We want it on our doorstep. We want it perfectly safe. We want it cheap, and we want it in 100 different forms. And so it's not going to get any easier. Secondly, nature. We think we've conquered her. We think we've got genetic seed. We think we've got shipping problems figured out. We think we're well on the path of finding alternative oil. But we really haven't had, and luckily over the last 3.5 to 4 years, we haven't had much in the way of hurricanes and adverse weather and et cetera. Now we've seen a little bit of adverse weather in the grain markets with problems in the Chinese crop. We were having possibly an early frost on top of a market that had a late planting season. And so as we go into Sunday and Monday, we're liable to put a tremendous nick in what was thought to be a record supply of grain. And that put us in a very bearish posture in the market. But as you can see, we've probably already reached the period of highest supply, I should say, in the grain markets. And as we go forward 4 and 5, 6 months into the future, we're going to find out that we've eaten through that supply. So nature, we can't have nature throwing us a curveball occasionally because the demand is running so high and production in most instances is running almost at a record or at as much as we can garner. And therefore, any kind of mismatch out of nature is going to put us in that problem. Well, here I go on my soapbox, peak oil. You know, Saudi Arabia and other OPEC producers have been injecting water in the ground to get their oil production to go up and up and up. Last month, Russia, for the first time since the fall of the Soviet Union, went above the Saudis as the world's largest oil producer. And that's the result of them regaining their footing and the Saudi Arabia seeing theirs level out. And so peak oil, I think, is a very significant argument. Now, you can say there's 30 years, 40 years, what have you, of oil left. That's fine. But what we have to realize is without having $55 crude oil, we wouldn't have the tar sands oil. And that's what I was going to say to the regulators. We were within $6 of shutting down the tar sands oil within the last 5 or 6 months in oil. And you're thinking that crude prices are excessive. We're just about to shut down a significant portion of the new oil supply we brought on. And so prices aren't high enough. And so, but peak oil and garnering oil, is there plenty of oil? Is there plenty of energy? Yeah, there is, but it's going to be at increasingly higher cost when you make it out of tar sands or oil shale, or you get it from wind and solar. All these other things have a cost and a cost to implement. And so peak oil means we're going to have higher oil than we think we're going to have. And secondly, higher oil prices does what? It increases the cost of production in every physical commodity. It increases the cost of production in the metals markets. We're digging deeper and deeper in the metals markets and the oil mine and the gold mines in South Africa. And now South Africa has to care about the safety of their miners. Before they didn't have to. And so when you add that exponentiation factor of higher oil, you're getting higher and higher cost production levels throughout all commodity markets. So that peak oil is not an insignificant development. Peak production in copper, gold, and cocoa is something we're also having to contend with. You know, at any given time, people say someone's trying to corner this industry. They're trying to maintain a monopoly or something. When the amount of money it would take to corner the cocoa market is very small compared to some of these leverage buyouts that you see on Wall Street. And so here we have the cocoa market relatively small at 2.7 million tons of production a year. And granted, now prices aren't as cheap as they used to be. But when you had $500 and $600 per ton cocoa, you could have owned the world's cocoa supply for the cost of a good IPO. And so there are markets like copper and gold and cocoa and other markets that you can only get so much blood out of that turnip. So as you add the billion and the $1.5 billion and the $2 billion from India, China, and other parts of the world into these equations, these smaller markets are going to be like the canary in the mine. They're going to show you that they cannot live up to that type of production. So we're near that in some of these markets. And I think like a number of my colleagues in the industry, Jimmy Rogers was talking about you just can't go out tomorrow and say, poof, we've started a new copper mine. It takes a while to do some of that stuff. Well, nature has its limits, and so that's going to cause a lot of shifting and rotation as we go forward. So that's another upward bias. Oil profits. The risk has become so high in the oil sector that the oil companies are demanding larger profit margins in order to go out and take crude oil and refine it into the products. And so that's kind of, in my opinion, there's one of the biggest sources of high energy prices is big oil. If you look at the refinery operating rate, it's falling. We have 16% of our refineries idled at this point. And as we go forward in the next 5 or 6 weeks, what are you going to see? Less and less and less refinery operating capacity. Why? Because they can name their own tune. Why? Because if they don't, they're going to have a buildup of heating oil and gasoline stocks, and they won't be able to get the premium that they would like. Now, wouldn't you like, what's that song, that game show, Name That Tune? That's what they do. If they don't like the refinery operating rate, let's perform some maintenance somewhere. Let's just idle these because we're doing a seasonal switchover. And bang, bang, they firm up the structure of oil prices. They start tightening their products that they're eventually going to sell into the marketplace. So we have this situation, and we're focusing on anti-speculation in futures instead of solving one of the structural problems that you have, and that is it a completely open market when it comes to refining oil into products? And you know, I think all you got to do is follow the money. Right after 9/11, in the ensuing quarters, I think ExxonMobil had a $30 billion profit. So, I mean, it is lucrative to be refining oil. But there's not enough companies involved in that. We need, and that what would you call it, like a juggernaut or a kink in the road, so to speak, in the supply chain. It's tough to get that supply through that area. So if you look back over the last 5 or 6 years, have we had problems with geopolitical forces in oil? Yes. Have we had problems with weather? Yes. Did we have refinery shutdowns because of a double hit from the hurricanes? Yes. But we also have this situation where no one's paying the refiners to take the risk of refining a product when they can't get a good profit for it. So unless someone's going to come in and say, hey, operate these for the good of the country, we're going to have these structural supply tightnesses built in. And I counted since 2004, we've had 4 bull markets in the energies that were mostly sparked as a result of the refinery setup. And so until we get that, because people can't go out and buy crude oil and put it in their car, you got to have the heating oil and the gasoline and the diesel fuel for the final user. And so that's a huge problem we have. And globally, we haven't made a change to get any more refineries. So it's still a huge juggernaut. Anyway, everyone talks about China and India. You talk about Chindia. Well, if you ask me, China was stage 1, and they really sucked down on the commodities physically. They took them out of the world's use just as quickly as possible. And India never lived up to its full potential. I'm a big proponent of National Geographic magazine. Have a lot of stories in there about commodities that are very forward-looking. 6 months ago, they had a story on India about their new road system that they implemented. And they have a new road system that goes around the entire country, and they're getting ready to put another road right down through the middle of the country. And you know what it did? It was just like going in and having a heart bypass surgery. It had all these clogged arteries. It would take you so many hours to get from a rural area into downtown in a major metropolitan area, and now they've facilitated that by this road system. And now their commerce and their standard of living, in addition to the call centers and all these other internet things that they had been participating in, now they're going to get into the real physical consumption. So as I look forward, India and South America have the ability to be huge commodity consumers as we go forward, and that's not even counting China's going to stay in the game also. But anyway, that oil multiplier is very important to realize, because we do, even if we have oil back down at $50, that's really kind of twice what oil was 5 or 10 years ago. So every time you start a combine or start a tractor or send someone down in a mine, every time you do that, the costs are going to be exponential. So in the metals, how have we changed? What did we used to do historically, and then how have the markets changed to today? Well, you know, it used to be that inflation, you really only traded gold when you saw inflation coming, or you might sell gold when you saw deflation coming. And there was kind of a one-trick pony. Back in the early 80s, you used to see a lot of interest rate spreading. When we had 25% prime rate, you had people doing the carry spreads, and it was an interest rate play in the gold market. Well, now we're kind of at the other end of that, totally at the other end of that cycle, in which instead of prime rate being at 25, prime rate's down to virtually nothing, and we're probably getting ready for interest rates to begin to climb. So there's going to be a major shift, maybe going back towards some of that historical type of trading. But since then, we saw bouts of flight to quality. When we had the Asian currency crisis, when we had the breakdown of the Soviet Union, when we had the subprime crisis, you saw a resurgence of flight to quality. So these were present in the past. But what we have now is we have all these going forward of now we have the old and we have the new influences in the metals markets, which is creating speculative interest, it's creating volatility, and I think it's going to create much higher pricing. We still have that physical commodity status. You know, I write day in and day out, and I find that this South African mine might have a strike. This production was down in South Africa. The markets don't care about that right now. The markets care about whether the environment for investing in gold and silver is still going to be expanding or if it's going to be contracting. It used to be an interest rate vehicle. Now it's virtually no interest rate action going on into gold and silver. But what I'm saying is that could be poised to change. Well, and it used to be a geopolitical indicator. People used to trade gold. They used to trade the TED spread. They used to have, but now we've kind of diversified to where we've got Treasury bond futures contracts. We've got all these other quasi-inflationary factors that you can play in other markets. Except when you go into those other markets, you get off on a slightly different track, because the inflation aspect of U.S. Treasury bonds can be impacted by our record deficit and our borrowing. The currency markets can have internal country factors that influence, whereas gold is really one of the best markets right now for, is the economy recovering and are we going into an inflationary scenario? And so to me it's hard to argue that we're not going forward. So we have all these old patterns, and now we're getting what appears to be the end of dollar dominance. And so I think that instantly means that people are going to continue to filter more and more investment into the gold and silver and other stores of value. I think if there's anything that the world has learned, and that is you really can't trust any currency. You need something that has no government that's going to make any kind of decisions that's going to influence that particular store of value. And this is kind of a universal store of value that even though it might not have a lot of economics, the gold-silver ratio, there's no fundamental attachment between the two instruments, but this is a very deep attachment to things that are not, paper assets. Gold is the primary and will always be the pinnacle of the hard asset category. But anyway, so now we're getting into this situation in which we see something that's never happened in history. We have the world's largest central bank that's on a virtual daily basis, almost hourly. I haven't heard someone since this morning at 9 o'clock say it from the Fed, but they said it this morning and yesterday and Monday and last Friday, and right after they said that they're leaving interest rates change, they came out and said 2 hours later that we're going to leave interest rates at low levels for a long period of time. Now when Paul Volcker and Alan Greenspan were in the head of the Federal Reserve, they would cringe at the thought of doing that kind of moral suasion, that kind of inviting of inflation with those kind of statements. And so what would make someone say those kind of statements? Because on the collapse last summer, those people sitting in those buildings in Washington staring at each other, they knew that the canoe was just about to go over the waterfall. And they know that the canoe is still hanging off the waterfall and that they cannot afford to have a backlash in the economy. We've borrowed so far into debt that if we don't inflate, if we don't stimulate, there'll be no way to ration out those toxic assets. There'll be no way to support the real estate structure in the United States. And so they're biting on to the lesser of two evils, and that is to stimulate inflation and to avoid the slowdown. And so you add up all these fundamentals, and if I'm a gold bug, I don't think I could have dreamed of this type of a setup in my wildest dreams. Could I ever have thought that the U.S. Federal Reserve we'd be so far gone on our borrowings that we would have to forcibly instill, prompt, and maybe even aggravate inflation. And so as we're going forward here, the new market focus, again, I think we're already factoring inflation in there, but we haven't seen anything yet because half of the people don't believe that the economy, rightly so, is back on its footing. But when you get back on a solid ground, if the Fed's not very quick in terms of pulling back on the reins at that time, then you're going to see the real type of the secondary type of inflationary wave kick into the metals markets. So and what makes it so powerful is when you look at the modern metals markets, instead of just those guys that wore tin hats, that's what I like to call them, the gold bugs, the tin hat guys, the guys that are always looking for the Martians to come down from outer space. For 15 or 20 years, if I would write something and it would be bearish on the gold, I'd get all these emails from overnight. You know, I don't want to see anything bearish on the, I think that's even come back. We do some commentary for the Board of Trade, and if we would have something negative in there, we try to have no opinion in those comments. But if there's a negative comment, you're going to hear about it. But anyway, not only do we have those individuals, but now we have a tremendous amount of fund managers who are running stock portfolios that are hedging against inflation. We have people that are hedging against currency exposure. We have people that are fearful of they're hedging their stocks from going down in the case of rising interest rates. And so you have all these different participants that are piling into the gold market right now. How I calculate, and I'll show this a little bit later, the net spec and fund position in the gold market, we hit a record 2 weeks ago. Probably as of Tuesday's close. We're going to do that again this Friday after the close. But I have a belief that just because we have a record long, there's a reason for that. And records are meant to be broken. And until the conditions change that are causing people to go into the metals markets, when people say to me, how high is gold going? I say, I don't know. But I think that it's not done going up because the conditions are all in place. And so we have more people coming in and we have diversified ownership. Now, I'm not too sure how the ETF boys are going to handle the volatility in the gold market because just like they were in the internet crisis, we do have volatility. We saw, I believe, not this year, but last year, we had 3 breaks of $150 in gold. And that can happen. I'm not sure how the ETF guys are going to handle that. Whether or not, so that's going to cause a little bit of volatility. We have leverage and we have options. When you have options on futures, you have the ability to contain and control your volatility, and I think that's where our big edge comes over these other forms of investment in the metals markets. But make no mistake about it. We have the classic conditions for inflation. We have more players involved than we've ever had, and we have scenarios that are really beyond the control of our central bank, and I like to call that 300 million-itis. We get into the United States, we get into this view that here we are, we're the king of the world, that the central bank or the Fed's going to control the inflation worldwide. And I like to say to that, well, that was okay when we were the biggest stick on the block. But now as we go forward, unless the Federal Reserve can make a barrel of oil or produce an ounce of gold or produce a ton of copper, that they may not be able to stop this kind of inflationary rise, which comes right out of the heart of the commodity markets. So going forward, you can see this is a busy chart, but this shows you all the big events that we've had in the gold market and how this since 1970, some very big, huge changes. And so the reason I put this up is because this kind of environment breeds these kind of major changes. We had several discussions already today about how the claim that the oil producers were going to repeg their oil sales in some basket of currencies or in gold or some other item. I mean, that's a huge, huge potential structural change. And again, do you really think that you would lower the volatility in energy prices by tagging it to gold? Or you might if you put it on a basket of currencies, but that's not going to change the overall scenario. Well, let's go I'm going to start drilling down right into the gold market and the silver market as we wind it up here. But look at the gold consumers. Here's India, and then you see China over there, which on this chart was half of the size of India. Well, today the World Gold Council came out and said they see Chinese jewelry demand rising to the #1 in the world. So we're already seeing China double and come to the size of India. And again, the pie doesn't get any bigger, you know, in terms of production, but the pie's getting bigger in terms of consumption. And so as we go forward, look at world gold mine production declining. Why is that? Well, the price of gold 3.5 years ago was actually below the cost of production. People were saying, look, $250, $280 gold, I don't think I want to do it. And then after apartheid and changes in South Africa, when they said, no, now we're digging miles deep and we need to have cribbing and an escape plan and clean air and fair wages and pension and medical, all these things have started to get more expensive. And so What are we seeing? $700 gold, did that inspire production? No. Has $900? No. Has $1,000? No. We haven't seen an increase in production. And I said in an earlier taping today, it might take $2,500 gold to get gold out of the oceans, to go out and get it out of seawater. And so if I would have said 10 years ago, crude oil is going to $55 and we're going to use tar sands in Canada, they would have laughed at you. And in fact, they were laughing for quite a long time until about 4 years ago. And then they were jokingly and making fun of that, and it's become a reality. So look at this. We're going in the opposite direction. South African mine production is declining also, starting to level out a little bit. So the high prices had some influence. And the positioning, this was several weeks ago, the net spec and fund long, these are people that can be long or short. You know, if you're a commercial or a producer or whatever, you don't necessarily have the ability to be long or short. But these are the funds and specs. That's what I categorize them as. And it's a record spec long. And again, most people say this is a top in the market. I'd say this is telling you that something's wrong, something's out of balance, and people are piling into the trade. Well, look at this. Here's the world silver, new supply and demand. I'm getting into the gold-silver ratio suggestion here. Because as I look at that last chart and I find out the record long in gold, we hit record highs in gold prices. We're seeing gold production go down, but I look at this and I'm like, wow, we've had a structural deficit in silver for a long time. When you look at some of the derivative products that came on, after they came on, we saw this unbelievable implied demand start to come into the marketplace. And so even though the physical production hasn't picked up, the investment demand for what little we had has already soared off the charts. So my stocks to usage ratio in the silver market has now become egregiously tight. And going forward, look at the warehouse stocks. Warehouse stocks have not responded. We're not seeing stocks rise. That's not surprising because people want it. They're not going to put it. They're not going to give it to someone else. Look at world silver demand. We have industrial, jewelry, and de-hedging interest. And I would say that the industrial component of demand in silver and copper have been holding back their prices. Why? We're in a recession. The industrial demand's not given any respect. So $17 silver prices has very little demand. Real demand, the old type of demand, has very little of that factored into the equation. So as we go forward here, you know, we're getting to the end of de-hedging, and if we were to get any kind of recovery in the economy, we're going to all of a sudden find out that the metals are going to go to an even higher trading range. The silver market, this is the Commitment of Traders positioning report, so the spec and fund guys, the guys that can be long or short, they're long, but they're not a record long. Where are silver prices at versus the record? A fraction, not a fraction, but a third or a fourth, depending on what you want to look at, of their all-time highs. So when you look at that relative imbalance, the trade is loaded into gold to a large degree. I think it's going to go higher, but they're not nearly realizing that same kind of opportunity in the silver market. Look at the ratio. I think that in fact gold's going to continue to gain on the silver market in the near term. But what's going to happen is, and we've seen this before, I don't know if anyone remembers this, but within the last 10 years we had a situation in which platinum prices got so high that they were considering the use of gold in catalytic converters. Now think about that. Anyone know off the hand what's the cost of palladium? What's the price of palladium? Anyone know? How many people have even thought about looking at palladium in the last 6 months or a year? Because here's palladium sitting at this low price, could be a substitute for platinum. In hardly any way is it participating in the same kind of run-up that we've seen in the gold market. And so if I'm a systems trader, I'm going to try and play on this. In the grain market, we look at this all the time. We're looking at soybean oil, meal, and crack spreads and crush spreads in the cattle and so forth. And you got to look at this because gold's going to be the tip of the spear. And gold's going to continue to get the flight to quality, anxiety, and the hoopla. Okay? But when the economy comes around, if it does, or if inflation really starts to catch hold, then people, the lower metals, silver, platinum, and palladium, are all going to be looked at for two reasons. Either the increased physical demand, which I got to tell you, when I look at the cocoa market, and then I look at the platinum market, and I look at palladium, if you look at a global map of where platinum, palladium, and cocoa are produced, you'll say, well, where is it? I don't see. Because it's little dots on the map. It's not produced everywhere. You can't turn this on and say, let's double the production of platinum and palladium. It can't happen. And plus, it's in areas of the world like Russia, in which it's going to take a lot of higher price in order to get that production to get going. And so as I look forward, I say gold long gold versus short silver for now. But as we start getting to a point where gold prices are getting untenable, I don't know what that is, 1,300, 1,400, or the commitment of traders positioning is whacked up, the options are costing tremendous amounts of money to participate in that avenue, people are going to start looking. They're going to go to platinum, they're going to go to palladium, they're going to go down that curve. And so you can achieve, there is no relationship between gold and silver, but there's a lot of relationship between platinum and palladium fundamentally, a lot of strategic uses, medical uses, manufacturing uses, those markets. So platinum and palladium is a good spread. And again, you know, platinum's going to gain on palladium in the near term because it's topical, it's better known, it's more participated in. But as we go forward, I think you're going to see that. It's going to be like a booster rocket. Gold goes off, drags up silver, drags up platinum, drags up palladium. When we finally get to the top of the market, I think you'll see those last three markets top off. Gold will make the top first and come around. But as I look, platinum, you know, platinum has a record spec and fund long position. But when you look at its relative price structure, it's not nearly as cheap as palladium. But it is, look at this, we're talking 22,500 contracts net spec long, and you go into the silver and it's 70, and you go into the gold market and we're talking 307,000 contract net spec and fund long. So big market, smaller market. So if money starts to go into some of these lower metals markets, you're going to see, again, big world, small markets, that's going to cause it to go. And one last thing I'd like to, I'm running out of time here, but I want to make sure that, you know, earlier this week we had a major fund that said they're going to reallocate their investment portfolios. And as I look through that, I realized, well, there you can see that we're going to start to respect some of the position limits that may be required in certain markets. But what I also saw was that they were going into these markets that they didn't have exposure in. The world wants commodities. And if they have to go into these esoteric markets to get their exposure, they'll go into the markets. And we saw this in that 2004 to 2005 timeframe when the funds first started coming into commodities. And they've piled into crude oil, and they've piled into some of these corn market and sugar. They've piled into that. Now, as we go further and get inflation wrapping out and becoming more of a reality, then you're going to see those other markets, silver, palladium, platinum. You're going to see wheat, natural gas. I mean, when you go through and look, people are net spec short natural gas and copper. Natural gas within the last 2.5 months was below the cost of production for offshore oil wells. So, and we got someone that's net spec short, and the BTU comparative price between natural gas and crude oil was reaching out to a record extreme. And so when you talk about, we have record natural gas storage. We have more natural gas storage in storage right now than we've ever had in the history of mankind. And it's just waiting to be arbitraged. And so if you watch the crude oil natural gas spreads, there's a huge amount of long crude short natural gas that's underway right now. It's like long gold short silver. And when that thing starts to turn around, you're going to see it. So it's the market's mechanism of substituting, of using prices to allocate resources. And that's going to happen, and we're not going to stop it from happening. And so if I'm a trader and I'm a systems trader, I'm going to be looking a lot at those relationships because it's rare in history that you get to see such a laboratory. You can talk about this in economics classes. You can say this happens, but to have something happen where you say, wow, palladium should now be used in catalytic converters, or some other major change. I mean, we're going to use tar sands. Now, 10 years ago, that was a major event. To see all that stuff compacted within a 5 or 10 year period is quite epic in history. And so I think we're going to see it in the near term. So right now, we're sitting here, and it's going to be difficult to head off this train. I don't think they want to head off this train. The question becomes, what happens right after we start to see the employment rate start to level out, or we start to see, like maybe now, we've had the Alcoa earnings. If we see any kind of top-line sales growth in some of these corporate earnings reports, if we feel like we're starting to get a grip, instead of slowing in the economy, we're going to hold, and we're going to start to climb out of this a little bit, that inflation is going to peek its head around the corner, and people, I do a lot of hedging with corporations, and they've been going hand to mouth because of the recession. They've been making money by having their costs cut down. But now they don't realize they may be facing this huge spike in physical commodity prices. So it's going to be tough to stop that. It's going to be tough to stop the price of oil, and it's going to be tough to stop the spread of investment into all these commodities. So right now we're going to have that. We're going to have renewed bouts. We're going to, every time we come into an unemployment report, there's going to be a little bit of a fear. But I have a statement. After 25 years of being in this market, when you see an event, I don't care whether it's Chernobyl, subprime, Asian currency crisis, we have a major reaction the first day. 9/11, major reaction. Then we have the next day or 2 days or a week later, like in Chernobyl, we had the big blast. There's going to be radioactivity all over Europe. That was the first fear. We're going to have a China syndrome meltdown. The reactor's not going to stop. Got over that. 3 days later, guess what? The radioactive cloud's blowing into the Ukraine and into Eastern Europe, and it's going to infect the grain crops. We're going to have a huge food shortage for 50 years in the future. Another reaction. But the second reaction was less than the first. Then we went in and tried to contain the core, and they couldn't get it contained, and they had a couple mishaps. They had several people die. Another flare-up, but yet smaller yet. And so that's where I derive my theory. 3 times, and the markets don't care. Subprime, subprime 2, we've already had subprime 3. And in fact, we've tried to rekindle this fixed rate, variable rate lock problem. It's supposed to happen in November, December this year, and no one cares. So we're kind of virtually done with that. The economy's bulldogging its way back. People want to have prosperity, and we're not as big of an impact on the world economy as we used to be. And so the Fed, never in its history, they're going to have to orchestrate over one of the most inflationary spikes we've ever had, and it's going to be volatile. There's going to be a huge amount of opportunities in the marketplace. And if personally, I would say you got to focus in on some of these relationships. Maybe that'll diffuse some of the risk for you. But you can also utilize options. I mean, options are a very effective tool. I have a lot of commercial hedgers, and they sometimes have been buying multiple years. I've been doing this 25 years, and starting 4 years ago, I started to get my grain customers to buy multiple years of grain. They would buy multiple years of supply of a commodity. And now we're seeing other companies do that also. And in order to stomach that, for waiting for those relationships to come out as we think they will, they're metering their risk with options. And if that's the last thing I say today, that's the most valuable. And that is, you've got to constantly control your risk. In order to go get abnormal rates of return, you have to control your risk. And the tools are there to do it. But as I put all this stuff together, I've just never seen a collection like this that has come together. And subprime was just a pause in the action. And the world, I think, really wants these commodities, and they're just not going to be deterred from that. And so look at those intermarket relationships. Look at what's the impact of extremely low interest rates, extremely aggressive quantitative easing, and large deficits around the world. It's quite a prescription. And so I think the volatility can be our friend if we know which markets are undervalued versus others. So control your risk and try and participate. Any questions? Any markets? Okay, thank you.